Short one before we start. Warsh's June statement ran 132 words, no dot from him on the dot plot, and the 30-year still climbed to a 19-year high.
Hold on. Shorter statement, no forecast, and yields ran that far?
That's the part nobody put in a headline.
The headline everyone did print was Fed Simplified Communication. Greenspan style, less noise.
Right. The consensus read that as discipline.
The bond market read it as something else.
So which read is actually right?
Welcome to the Trade Room. I'm August.
And I'm Blake.
You've been wanting to talk about this all week.
Guilty.
We are starting with that June FOMC hold, unanimous vote, but a hawkish shift buried inside it.
Then July 29th, 30-year near that same 19-year high, 2-year moving the opposite direction. We'll look at what Ben Emons and Bank of America made of that steepening.
And Jackson holes on the calendar, 120 attendees, an official theme about payments in financial innovation.
Which isn't what the room actually wants answered.
We'll test whether Fortune's read on that June press conference holds up too.
And we close with Reprice It, where the numbers should have screamed louder.
Should be fun.
So, walk me through what's actually missing from those 132 words.
132 words. That's the FOMC statement in June, down from 341 in April, and Warsh submitted no dot at all. The 30-year Treasury sold off anyway, straight to a 19-year high.
Okay, so get this. The headline version everyone ran with was simple. Too simple. New hawkish chair, tough talk on inflation, markets get nervous, markets adjust. Nothing structural.
Which is the frame everyone bought.
Warsh even explained it himself. June 17th told reporters that forward guidance isn't the business the Fed should be in. That's what the Hill and Global Finance both ran. Framed it as cleanup, not a shift. That was the story they sold.
Simplification, according to him.
Right. Shorter statement, no dot, no forward guidance, just less paper, same policy. That was the pitch anyway.
Except that's not what the tape says. Bloomberg flagged that yield spike the same week he called it simplification.
Wait, same week?
Same week. We were already sitting with these traders back in June, pricing that meeting before any of this credibility shock language existed.
And the July 29th tape reads nothing like calm adjustment.
No, it reads like a market that heard something completely different than the press conference.
So the question isn't whether Warsh talked tough.
It's whether the people holding the bonds believed him. What were they actually positioned for going into that June meeting?
Rewind 3 days, June 17th. Unanimous hold 350 to 375.
Unanimous on the vote, sure, but CNBC's readout of the dot plot told a completely different story.
Okay, walk me through it.
Okay, so get this. Median dot jumped to 3.8 for year end. Fox Business had 9 of 18 participants penciling in a hike from here. 6 of those 9 wanted 2.
Wait, a majority leaning hawkish and the headline was just hold?
That's the gap right there, and the 2-year didn't wait around for confirmation.
How much did it move?
Con Capital put it at roughly 16 basis points to 421. That's the biggest Fed day move in the front end since March 2008. That's the number that actually mattered.
2008? Seriously?
Seriously. Meanwhile, the 10-year slipped to about 445.
So the front end's climbing while the long end eases off.
That's a bear flattening. Short rates rise faster than long ones because the market's pricing near-term hikes, not long-run inflation risk. Spread compresses, curve flattens.
So traders read hold out loud but traded hike underneath.
Right, and here's what got buried. Fox Business flagged that SEP raised the 2026 PCE forecast to 3.6%, up from 2.7 in March. That's a full-point inflation call sitting in a report nobody reads live.
A full-point higher inflation call sitting in a summary nobody reads live.
That's the number. That's what people were actually trading, not the statement language.
So what were returning desks positioned for walking into that Wednesday?
Talked to a few after. Most had steepener trades on, betting cuts were still coming this year.
And the dot plot blew that up.
First 90 minutes, they're unwinding steepeners into flatteners, real money getting run over.
So June was the front end's turn to panic.
June was bear flattening.
Wow.
Wait till July. Same chair, same framework, and the market inverts the whole shape.
Flip that to the long end now, because July 29th broke a different way. According to Bloomberg and the Taipei Times, 30-year yields jumped as much as 14 basis points, touching nearly 5.23%, a 19-year high.
Sure, and the 2-year did the opposite, fell.
Same afternoon.
Oof, okay, so get this. That's a steepener, not a flattener. Front-end pricing in patience, long-end pricing in doubt about where inflation actually lands.
Biggest move of its kind since the mid-90s by Bloomberg's own read.
Right, and Ben Emons over at Highline had the line that stuck with me. Taipei Times quoted him saying the steepening shows the policy strategy lacks credibility.
Credibility of what, though? That's what I keep circling. Credibility that inflation falls? Credibility that the Fed will act if it doesn't?
Emons draws it out further, and the interesting part is his point that being hawkish without acting just lets the market do the tightening for you.
Which works until it doesn't.
Exactly his point. He flags that it backfires the moment inflation accelerates and the market decides the Fed is behind again.
So credibility here isn't a vibe, it's a rate. It's whatever Treasuries settle on when nobody explains the plan.
Bank of America called this a central bank inflation credibility shock per Fortune's write-up, and their read is almost backwards. The shock actually raises the odds of a September hike.
Wait, dovish silence forcing a hawkish outcome?
That's the mechanism. Warsh has to re-earn the credibility the market just stripped him from, and hiking is the fastest way to do it.
Which is wild because nothing in the statement was dovish, it just said less.
And wait for it, Apollo's Torsten Slok has the analogy everyone's repeating. Fortune ran it Saturday. He compares it to promising someone a trip from New York to LA without saying how long, what it costs, or how you get there.
Let's actually test that, though. A trip has a knowable endpoint. Inflation doesn't. You can't hand the market a fixed itinerary for something you're still fighting.
Fair, but Slok's point isn't the destination, it's that you at least describe the road. No route at all, and people start pricing their own detour.
That's the steeper curve, then. The market building its own forward guidance because the Fed won't.
And that's expensive for anyone with a mortgage or a car loan who's never opened an FOMC statement.
Which is exactly the bill coming due before August 27th.
When Warsh has to defend all of this live on stage at Jackson Lake Lodge.
Widening out, Jackson Hole is next, and the printed agenda doesn't match the fight everyone's flying in for.
Sure. Finance calendar has it locked. August 27th to 29th, Jackson Lake Lodge, roughly 120 people from more than 70 countries. Chair keynote lands Friday morning.
A room that small, deciding something that big.
Okay, so get this. The printed theme is financial innovation, payments, digital money, stablecoin frameworks. That's the official topic, straight from Finance Calendar's listing.
Nobody flying to Wyoming is losing sleep over stablecoins.
Every reporter in that room is asking about the dot plot anyway.
Which loops back to something we ran in June. Kansas City Fed's own history of the symposium leans hard on the Greenspan era, years where the chair's words carried the policy over any printed length.
Warsh is reaching for that exact model. Talk plainly, let the room read intention.
Except talk stopped being free in July.
Fortune quoted Brookings' Robin Brooks calling the June press conference largely performative. His read is Warsh needed daylight between himself and a White House pushing for cuts.
Do traders actually trade that theory?
Some do. It's one read floating around, unconfirmed.
Theater against policy. The tape prices them both the same way.
Doesn't discriminate.
Which matters past the lodge. A 30-year yield doesn't stay in Wyoming.
And wait for it, it lands in a mortgage quote, a refinancing call, the discount rate under somebody's retirement account.
So whatever gets decided up there isn't staying up there.
It's already in people's numbers before anyone's read the statement.
Building on that, the number people actually feel is the 30-year, not the front end.
Right, that's the one setting your mortgage rate.
Walk me through it, though. Why does a 30-year Treasury move a 30-year mortgage?
Okay, so get this. That yield is the risk-free anchor. Lenders price the loan as that yield plus a spread for prepayment and credit risk. At 5.23% on the Treasury, 30-year mortgages are pushing toward 8%.
And it's not just mortgages.
No, it's every pension fund discounting future liabilities, every company refinancing a bond that matures next year. The long end prices anything with duration.
So Jackson Hole isn't some ritual for people who read statements for fun. It's the rate deciding whether your neighbor refinances or sits tight.
Now, the part CNN pushed back on, the 2-year's been trading well above the Fed's own 3.75 to 4% range for weeks.
Meaning the market already tightened on Warsh's behalf.
That's CNN Business's argument exactly. Their read is the credibility shock framing overstates the danger because the front end did the Fed's job without a single vote.
A skeptical if you're Warsh.
Maybe, but it's fair. The tightening happened either way.
Friday's the test then.
Fortune flagged it directly. A strong payroll print revives the inflation story, and on Bank of America's logic, that steepens the curve further.
Wait, stronger jobs pushes long yields up, not down?
And wait for it, because it kills the case for cuts. Growth without a path to lower rates makes duration riskier, so investors demand more yield to hold it.
So a good headline for workers is a bad one for anyone refinancing.
That's this whole quarter's trade.
And the people who priced it, they're next.
Because come August 27th, somebody has to explain what they missed.
Rapid round, building on that. What's the actual misprice here, in your view? And I mean actual, not the consensus version.
Okay, so get this. July, everyone bet killing guidance would kill volatility instead. The long end kept grinding toward that 19-year high.
Not June's dot plot?
June's was the warning shot. July's the invoice.
Noted. Already scribbling that down.
Should it have been, though? Warsh has been on record for years arguing the Fed's own communication was the problem, long before he ever ran a meeting.
So the April hearing wasn't new information.
It was the thesis, finally with a vote attached. Fortune's calling this a credibility shock this week, but it's the same argument he's been making since he was a governor.
Run it back. What do you actually change in the book? Not what you're telling people you're thinking, what you're doing.
I stopped fighting the front end, own more short duration, and fade the panic bit on the long end.
What single number in that August 27th keynote flips that?
In Inflation Path, he'll pin down and defend, not a mission statement, a number with a date attached.
And if it's another statement that reads like it's shrank overnight, just another Fed communication that says one thing and markets take another?
Then the long end keeps climbing, and half this desk finds out Friday who wasn't hedged.
Closely. We'll be watching August 27th then. That's where the gap between the printed agenda and the actual test shows itself.
Closely.
Short pause.
Sure pause.
Accountability round, quickfire. What went wrong here?
The Fed assumed dropping guidance would read as confidence. It read as risk instead.
Who should have seen that coming?
Worse, honestly. Years of him criticizing the Fed for over-talking, and then I built the exact vacuum the market's pricing now.
That's the credibility shock, not the calm adjustment.
Right. Run it back, and I don't cut the statement to 132 words in one meeting. You phase it.
So, one question for August 27th.
What number in that keynote flips your position?
Give me an actual path for rate signals, beyond payments and stablecoins on the agenda. Say that, and I'm covering.
Same. Otherwise, the tape sits right where it's been since July 29th.
New episode every Tuesday. Subscribe and send us to whoever called the statement change nothing.
See you in Jackson Hole. Sort of.
Thanks for listening.